In this video, you're going to hear me talk about how you can lower or vastly reduce your capital gains tax liabilities. This video is a follow-on from my previous one on how to reduce your capital gains tax bill, but adds a few more ways that weren't covered there. Let's go. First, let's start with a quick recap on what CGT, capital gains tax, actually is. In the UK, capital gains tax applies when you make a profit, i.e. you make gains on an asset that you dispose of or sell, and that asset has increased in value over the time that you've owned it. This is much the same definition that applies to many other parts of the world. Historically, there have been many allowances and reliefs available for you to offset your capital gains tax liabilities. But these allowances and reliefs have steadily been eroding for some time now. And given the debt that most countries are in, most governments are in, I don't expect those allowances and reliefs to return anytime soon. In fact, I don't see any other direction for taxes to go in the medium to long term than up. In any case, it's important to know the ways you can legally avoid capital gains tax, or at least reduce any liabilities that may crop up for you either now or in the future. And remember, this is about avoiding capital gains tax legally. This is not tax evasion. This is tax avoidance in the legal way. Evasion is a very different thing, and that is against the law. Tax avoidance can be legal. Tax evasion, however, is illegal. Get it? Good. And just before I go into these methods, these are for educational purposes only. I always recommend that you look these up and do your own research on these, or consult an independent financial advisor if you need personal financial advice. Now, the first and the most simple one is use a tax-free wrapper. I covered this on my last video on capital gains tax, so I'm not going to rehash that in full here. In fact, go and watch that one after you're done here. But what is also important to know, and this wasn't covered in the last video, is that you can move investments that might sit at the moment for you outside an ISA into an ISA. You might find that you have shares from years ago, or even an entire investment account from many moons ago that has mostly just been sitting idle. And as you've got more mature financially, you've done the smart thing and put new investments into ISAs through stocks and shares ISAs and the like. But that old one might have been left alone. Now might be a good time to consider shifting those assets into an ISA wrapper. This is especially true if you're not utilizing your full ISA allowance every year at the moment, or at least you're not intending to this year. Then you might want to consider transferring those assets into an ISA. Now, of course, you may incur transaction fees and even a price difference if the market moves significantly against you from the time you sell the asset to when you buy it through an ISA again. But if the aim is to avoid capital gains tax in the future, then this still might be a good idea. Now, if you're using your full ISA allowance already, then well done. Then consider utilizing the allowances of other members of your family, your spouse perhaps. And don't forget that even children have their own allowance, albeit a smaller one currently. And ISAs are not the only way. They are my preferred way to shelter against capital gains tax. But pensions are also available if you've maxed out your ISA allowance already. I'll link to a video here about why I think ISAs are a better option for me than pensions. Another way to avoid capital gains tax is to use your eternal losses. And no, I don't mean eternal in some spiritual way. If you've made a loss on assets previously, then those losses can be used to offset any gains you are making or are likely to make in the future. Let's say that years ago, you needed some money quickly and had to sell some of your shares perhaps at a loss, because having that money in your account at that time was more important. Now, if you're like most people, you did that and then never thought about it again. But you should know that capital losses are actually very unique in the way they can be carried forward, effectively forever. So unlike Wally, or Waldo if you're in the US, they can never be lost. Capital losses can be carried forward forever. And the added benefit is that these losses can be used to offset gains, not just against the one asset class that you made losses in, but against other asset classes as well. So for example, if you sold those shares at a loss and later made a profit selling a property, you can offset some of that gain made on the property transaction with the losses you incurred earlier on the shares. There are some rules around this, so be sure to check thoroughly what the current position is. And as always, I will always recommend getting independent financial advice before you take action on any situation. But the thing I really want you to be aware is, though these capital losses can be indefinitely used, in the UK, this is subject to them being registered as losses with the HMRC within 4 years of the end of the tax year in which they were incurred. Once registered, they will be there to use at any point in the future. Be aware of these time limits so you don't get caught out. And like anything else in tax and personal finance, these rules and time limits may change from time to time. And I should say, this type of use of capital losses to offset gains in the future goes for all types of asset classes: property, art, cryptocurrency, stocks and shares, mutual fund investments, ETFs, businesses, The list goes on. By far, the best way of not paying any capital gains tax is by not selling the asset you have. Now, this might seem obvious, but sometimes we can get really wrapped up in trying to minimize the amount of tax we pay in any circumstances. But in my view, the aim should be trying to keep as much of your money as possible. If you have no need for the money right now from that asset, be it property, shares, cryptocurrencies, or something else, then keeping it means you are not realizing a gain yet, no matter how much it's gone up in value from when you bought it. And therefore, no CGT is payable at all. Now, in most cases, in a lot of cases, reducing the amount of tax I have to pay means more money in my pocket, but not in all. Just be careful not to fall into the trap of reducing the tax you have to pay by such an extent that it means that you end up with less money in your pocket. So if you don't need the money now and your investments are doing well, or it doesn't matter to you that that asset continues to be in your ownership, in your possession, then maybe not selling it now is an option for you. Now, the last one here is to use your CGT allowances optimally. Time the disposal or sale of an asset that could result in a gain carefully. This will allow you to maximize your allowances every year. Now, I mentioned earlier in this video that the CGT allowances and reliefs available have been eroding over time. And to a large extent, I expect this trend to continue. But that doesn't mean you should ignore allowances that are available to you today. You should always try and maximize the reliefs and allowances available to you at any point in time. You can also get independent financial advice on how best to transfer assets between you and your spouse or civil partner to spread or reduce the capital gains tax liabilities between you both. This capital gains tax video is about all sorts of assets. I've got one on how to reduce capital gains on property specifically coming up in the near future. It's on the list to do later this year, so make sure you're notified of that when that goes live. If you missed my last video on capital gains tax, one of my best performing videos of the last few months, which outlines other ways you can save on capital gains tax, then click here to watch that next.